Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Let me begin by apologizing for my voice this week. I have been sick, but of course the show must go on. And it goes on in the form of US banks releasing earnings in the coming week. JP Morgan, for example, is set to release on 15th July, and the market will be paying a lot of attention to those numbers, and especially the comments that will be made about the state of the US economy. Not least of all because CEO Jamie Dimon is considered to be the most influential voice in the financial services industry, certainly in America and quite possibly in the world. And as a precursor to that release, comments made by him in the past week in Ireland are particularly interesting. For example, one of the comments he made that set tongues wagging was in relation to interest rates, with a statement that the markets were, and I quote, underestimating the possibility of US interest rates moving higher. He's right. Practically nobody is talking about this, with the prevailing narrative being focused on debates around the timing of cuts, not rate increases. Import tariffs and potential inflationary effects are the focus here, with the Federal Reserve voting unanimously to leave rates unchanged at their last meeting. Now, President Trump may hate that response to his approach to tariffs, but markets don't tend to care too much about the feelings of politicians, and especially not the bond markets, which already fired a serious warning shot at Trump earlier this year when the big noise around tariffs really started. Trump's administration would love to see a drop in rates, leading to pressure being put on Jerome Powell and calls for his resignation because those cuts just aren't happening. You can say what you want about South Africa, but at least our Reserve Bank remains a strong and independent institution that politicians do know better than to mess with. The very last thing that Trump would want to see is an increase in rates, creating a dangerous situation for consumer spending in the US, with a combination of higher prices due to tariffs and reduced affordability based on interest rates. Dealing with inflation is painful, and Americans are not accustomed to economic pain in the same way that we are. And of course, it's not just the tariffs that are inflationary. There are also factors like tightening US immigration policy and the widening US budget deficit, leading to a very public falling out between Trump and Elon Musk. And despite all of this, the S&P 500 is trading at all-time highs. If Jamie Dimon had anything other than grey hair, this would be giving him more grey hairs. Perhaps his eyebrows are now in serious danger of getting a silvery tint. Now, the market is not blind to these risks in the US. The rally in the S&P 500 is certainly being helped along by factors like dollar weakness, rather than just sentiment towards the US economy. But still, it feels as though a perceived lack of alternatives in global markets may be leading to an unsustainable rally in the US market. These things rarely end well, hence the warnings by Dimon. But what is the alternative to the US among developed markets? For investors who don't want to take emerging markets risk, the only meaningful option outside of the US is Europe. As I mentioned, the latest comments made by Dimon were at an event in Dublin, Ireland, so it seems like a fitting opportunity to talk about growth in Europe, or the lack thereof, sadly. In true American fashion, Dimon didn't mince his words. "You're losing," is what he said to the European officials and people of influence in the audience, praising Ireland for its open economy and suggesting that the rest of Europe could learn a thing or two from Ireland. I don't think he was talking about golf and music either. Europe is as famous for its bureaucratic culture and lack of innovation as its historical buildings and wonderful food. The tourism industry is probably the best thing about the region right now, so much so that I'm seeing increasing anger from residents towards the sheer volumes of tourists in their cities. But when you consider that the Euro Stoxx 50 index has only just made it back to the levels seen before the dot-com crash in 2000, while the S&P 500 is over 4 times higher than those levels, it would perhaps be wise for the Europeans to make significant progress in their economies before chasing the tourists away. Now, that long-term context is important because the recent performance of the European market suggests much enthusiasm around the region. If you wanted to buy a related index tracker on the JSE, you would have to look at the Signia iTrex Euro Stoxx 50 ETF as the only locally listed ETF that tracks that index. On a year-to-date basis, you would be up 21.5% in that ETF. And if you bought a comparable Signia S&P 500 ETF or any S&P tracker really, you would only be flat in Rand year to date. If you look over 12 months, the Euro Stoxx ETF would have returned 15.5%, and the S&P 500 ETF would be good for 10.5%. This just shows you how recent the positive swinging momentum towards Europe actually is, as the gap over a 12-month basis is much smaller. But which companies do you get in that index? Those who are used to seeing the Magnificent Seven in their ETF holdings would have to recalibrate their brains before looking at the fact sheet for that Signia iTrix Euro Stoxx 50 ETF. You're going to see some unexpected and old school names in there, like Siemens and Deutsche Telekom. As a throwback to the 2000s when oil names were top of the pops, you would also have Total Energies in your top 10 holdings, as well as Air Liquide in the industrial space. The two biggest holdings are tech names though, being SAP and ASML. The former is best known to South African investors as the software that always seems to be part of chaotic implementations at local retailers, with Spar as an excellent recent example. Ernie Els fans will also recognize the logo straight away. The latter is a name you might not know, but tech enthusiasts will be happy to learn that ASML is beyond critical in the AI industry, as they are producing the machinery that gets used to manufacture chips. And ASML is essential to NVIDIA, in case you were wondering. To round out the top 10, you'll also find Allianz, Schneider Electric, luxury market stalwart LVMH, and financial services group Banco Santander, which is a name you might recognize from Formula One. Only 15.8% of that ETF's exposure sits in the IT sector, whereas an S&P 500 ETF would have 31.5% exposure to that sector. It just shows you how much bigger IT is in America versus Europe. And this, of course, is the innovation point that so many people are talking about. The biggest sector in the European ETF is financials at 24.2%. And again, that's different to what you'll see in the US market, where the financials piece is only 14.3%, or less than half the size of IT. Now, your gut feel might be that the US index is more concentrated around the largest names, so you may be surprised to find that this is an incorrect assumption. The top 10 holdings in the S&P 500 ETF contribute a total of 35.6% of exposure, whereas the top 10 holdings in the Euro Stoxx 50 ETF are good for 40.3%. The clue is in the name. The European index has 50 holdings, while the US index has 500. Put differently, 59.7% of exposure in the European index is split across 40 names, i.e. everything outside of the top 10, while 64.6% of exposure in the S&P 500 index is split across 490 names. Food for thought around diversification risk. But if nothing else, Europe is on the map now. A year ago, or perhaps even coming into this year, you would have struggled to find too many people willing to bet on Europe ahead of the US. It is very important to remember that much of the recent performance differential is thanks to relative valuations, with European stocks trading at a vast discount to the US names. The question is whether that discount can continue to close. The other question is whether that closure would come from an uptick in European numbers or pressure in US stocks. Either way, the gap closes, but you can only make money with a long position from the gap closing through Europe catching up, rather than the US falling off. As we head into US banking earnings season, the market is collectively holding its breath. You can expect to see sharp responses to any negative surprises, including in the outlook statements by banking execs, and especially by the likes of Jamie Dimon. It's going to be a very interesting week in US markets.
There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.